Okay, guys, like I just mentioned, offline, this is being recorded. And one thing I say at the beginning of all of these, if you are new to options, watch this again relatively soon after getting it, because it'll help some of these little nuances stick in your brain longer. Even if you have been trading stocks, everybody knows how to pretty much do this strategy, right? Like you can go online and figure out how to do the strategy I'm going to talk about. I'm not going to tell you you can't find it anywhere. As a matter of fact, you can find it everywhere. But one thing they aren't going to do is give you strike location. They're not going to tell you how much credit you need. They're not going to tell you what kind of environment that you should be implementing this strategy in and what you want the environment to be like going forward. Those are all things I talk about because I've traded this strategy so many times and all these other strategies. I know what goes wrong. And those other guys just know how to build it. And that is not the key to success here. The key to success is increasing your probabilities. And that's what I'm going to try and show you guys how to do here. All right. What was it? Don Kaufman. What was it? Don Kaufman's spell correction on the last name. I don't know what we're talking. Oh, the guy that's talking about that. I will check it out. Sorry. Nothing sticks after 66. That's true. Anyway, so let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading in college with some money I had earned, trading stocks, selling some options against it, selling puts to try and get location on buying that stock. And then, I started building on that. After graduating college with a finance degree, I actually started out with a psychology degree and switched it over. I moved up to Chicago and walked onto the floor without even a resume, just had my name and number to write on a piece of paper and handed it out, got a job as one of these runners down here, jumped into the pits a little while later after selling all my stocks and started trading. So I traded everything from stocks, financial futures, commodity futures, currencies, and options basically on all of these products in just about all market conditions. I think the one thing that I've not traded is cattle, to be quite honest. I don't ever think I put on a cattle trade. But everything else pretty much was fair game. Let me get this out of the way real quick. Any opinions, news, research, or other information contained here or material provided by ProTrader Strategies and associated companies or employees is general commentary and does not constitute investment advice. Basically what this is getting down to is I can't tell you to go out and buy Tesla or go out and short Tesla or any of those things because I don't know what your risk parameters are and I don't know what's in your portfolio. So therefore, what I'm talking about in my outlook or market direction could be completely different than yours. So it's not responsible for me to tell you what you should be doing because I don't know to be quite honest. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right. You can follow me on Twitter at Wolfman's blog, or you can follow our parent company at ProTrader Strat. And this is going to be on the short butterfly. Like we talked about before we started here, offline, I guess. We did the call butterfly last week. This is the put butterfly. A lot of times the put butterfly will be easier to meet my rules because puts have a tendency to get more premium pumped into them. Another thing is, one thing I forgot to mention about the short call butterfly last week is with the short call butterfly, we aren't really directionally biased necessarily. The market assumption is to move in either direction, right? But with this, we would really kind of have a tendency to lean towards this being bullish, okay, with the put butterfly. Everything about the butterfly, you guys, is like Picasso. It breaks all the rules, okay? When we're looking at collecting a credit, we want volatility to go down. When we want, we don't want a big move generally when we're collecting a credit, all right? This, it's a put, and we want it to kind of rally, and we want volatility to actually expand. There's a lot, everything about the short put butterfly almost is counterintuitive to a lot of other option strategies. Like if you're selling option premium, generally you want volatility to go down so that premium deflates. Well, with the short put butterfly, you kind of want it to increase. There's a lot of different levers and pulleys, and it has to do with the way volatility affects those premiums that are closer to at the market, which makes this a little bit bizarre in that aspect. But know that when you're looking at the put butterfly, usually you're kind of thinking, well, maybe I want it to go down. We want this to go up because we want our short puts that are in the money to actually come out of the money, so we don't have to worry about assignment. We have protection if somebody out there comes and tries to put us that stock, but the fact of the matter is we have an option that can offset that as well. So keep that in mind. Ted loves cattle. Love the good old ribeye steak on the grill. Wow, that's true. But trading cattle is bizarre. To be quite honest, it's really a weird market. All right, so this is how we build the short put butterfly, and I'll give you a reason why it's called the butterfly. But one of the things is, first place we're going to start is getting long 2 at the money puts. And then we're going to go out and we're going to short an in the money put and short 1 out of the money put. Now keep in mind, this out of the money put to this at the money put is the same distance away as this short put to this at the money put, okay? Same distance away. That creates the butterfly. And the reason why it's called the butterfly is because you basically have, if you don't want to give me my pen, you basically have where we start. We're starting with these 2 strikes that are the same. And then on the option montage, we're picking 1 down here that's short and 1 up or down here that's short as well. Basically, the idea is there's your 2 and your wings. So that's your butterfly. That's a beautiful butterfly, right? But when we build this strategy, we need to build it so we are risking 1 to make 1. And they aren't going to tell you that stuff online, you guys, because you can set this strategy up where, you're risking $7.50 to make $2.50 or something like that, where you are risking a lot more than you can make. Because this is a low probability strategy, because we have to have a really big move happen, we need to be compensated for that type of risk. So don't ever go out there and when you're doing a short put butterfly, you have high risk here because it is a low probability strategy. Anytime it's low probability, you guys, and low probability of success, then you need to be compensated for that, okay? When you have a high probability of success, nobody's going to pay you for that, all right? Or they're not going to pay as much for that. So make sure when you're setting this up, it's going to be a low probability strategy, but we need to be able to make sure we are risking 1 to make 1. All right, and I'll probably say that several more times. Can you draw the PL? Help me visualize the PL. I'm not sure what that means, Wally. The P&L, are you saying? Profit and loss? The profit and loss curve. Yeah, I'll show it on the Analyze tab once we start pulling up the main platform, but yeah, for sure. All right, keys to success here. Picking the right environment. Now, this is one of those rules that you guys are going to have to really remember with the short put butterfly, right? When we are talking short strategies, collecting a premium, I usually say the right environment is an implied volatility percent of above 50. Well, with this one, it's kind of in a gray area. Usually when I'm saying, well, we're buying premium when it's below like 30 and we're selling premium when it's above 50, right? Well, what do we do when it's kind of like right around that 30 to, maybe even, let's say 15 to 35-ish area for a regular stock. I'm not talking ETF here right now. But this one is right in the middle. So it sets up really nicely for that middle of the road, that gray area where you're like, oh God, you know, it's not high volatility, it's not low volatility, it's kind of right in the middle. Well, this is the strategy for that. Somewhere between 15 and 30 IV% really makes this strategy work nicely. And you also want to kind of lean towards the low side of volatility because we would like that volatility to expand, which is obviously the other side of the short put butterfly. That is bizarre. Usually when you're short premium, you want volatility to go down. This, we want it to go up. So everything is a little off on this, but these are things we have to remember about the short put butterfly. All right. Environment, 15 to about 30% is the wheelhouse. It doesn't mean that you can't do it when it's below 15% or above 30%. That's just to give you guys a starting point, okay? That's where you need to really look at it. If it's too high, it's not going to work out. If it's too low, you're going to have really wide wings and stuff. So this is about the wheelhouse, 15 to 30% to get you started, so you know what you're so you're setting yourself up for a lot of I guess I'm saying that right. So you're setting yourself up to get through this quickly. If you start not following these rules, you're going to be all over the place for quite some time before you find one that fits. But picking the right underlying, with the right underlying, it basically is as simple as we need a tight bid ask. Okay, so on a stock, let's just say for Budweiser, it's under $100. So our bid ask in the option montage should be 10 cents wide. Any stock under $100, these option in the option expiration, that's about 30, 35 days, maybe even 45 days to expiration. That's the one to really look at. And these ones that are just out of the money, make sure they're at least inside of 10 cents wide or tighter. If it's over $100 stock, basically you just take the decimal, move it 3 ticks to the left, and that's how wide that bid ask should be. So, you know, you can look at something like Caterpillar, and Caterpillar's over $100 stock. We move the decimal 3 ticks to the left. We know 15 cents wide is what these options should be, and we are getting at least that 15 cents. These are even tighter than that. So start with that rule when you're looking at trading options, especially when you're learning to trade options. Now, if you've been trading options for 10 or 15 years, you know, you start getting the feel of where your premiums, you should be able to buy an underlying price at what delta and where to sell it for a good price. That's a different animal. Right now, when you're starting, you don't know those things. So please try and get close to that rule as best as possible. So tight bid ask. And then picking the right duration. With this one, collection of premium, you know, usually we want to shoot for around 35 days to expiration, or as close to 35 days to expiration as you can. You know, if it's 45 to 35 days, that's right inside of there. That's great. We're just slightly inside of that. It's fine. We are very close to 35 days. If you go out any further, you're going to be way too far out, and it's not going to fit all of the rules. So shoot for somewhere right around 35 days or as close to 35 days as you can. And it doesn't mean it has to be over. It can be slightly under, okay? Like I mentioned, when I'm talking 35 days to expiration, you can find that day right here. This is 29 days to expiration. So we're 6 days off on it. But that's where for some of you newer traders, that's how you can discern how many days are left before expiration. Right? And then picking the right strikes. Now this goes back to, like I said, I'm going to mention this several times. We want it to be risking one to make one. And what does that mean? Risking one to make one. You heard me say it earlier. That means like if we have a $5 wide wing. So remember the base, let's just say it's the 50 strike. That's where we bought our 2 strikes. We're buying the 50 strikes, and then we sell the 45 strike and the 55 strike to make that strategy. So it's $5 wide from the base to the wings, right? From 50 to 55, from the base to one of the wings, that's $5 wide. We need to collect $2.50. All right. So that's picking the right strikes. Now, how does that work out? one thing to start out with, it's a rule of thumb. It's very, very loose. On 100, basically you want to make your wings about 10% what the value of that underlying is. So if it's a $100 stock, you're going to basically be going, at furthest $10 wide. So from the $100 to the 110 strike and the 90 strike, and then work your way tighter. Okay. Always try to work those short strikes tighter to the at the money to try and achieve that 50% of the width of the strikes. Okay. Let me make sure so yeah, and one thing else it'll line up with is the 16 delta, and then go tighter, from the 16 delta that's out of the money, right, to the one that maybe might be a 20 delta and get closer to the out the money. But you can use either one of those, really. They're going to kind of land around the same place, but 10% the value of what the underlying is, that's how wide the wing should be. Or you can start looking at the 16 delta. Another even thing that lines up, to be quite honest, is basically if we're looking at a $50 stock, it's going to kind of be closer to $3 wide. $100 stock is going to be somewhere between $5 and $10 to the wings. A $200 stock is going to be somewhere between $10 and $20. So obviously $20 is the widest we're going to be looking to go, and then we're going to try and tighten that down immediately. And then also, knowing your exit strategy before entering the trade. If you guys have watched many of my webinars or any of my webinars, you guys know I do not ride this thing into the sunset to the last day on any option strategy, to be quite honest. And this one, because it is a lower probability strategy, I'm willing to accept less of my max profit. Usually I'm shooting for about 50% of my max profit on higher probability strategies. Well, this is a low probability strategy, so I need to be willing to accept less than my max profit. The max profit on this is much larger than what we're used to in collecting a credit. So in that being, we're getting a large credit, a low probability strategy, accept less and write it down. One thing to stay mechanical, you guys, is write down all your trades every day you do them, why you got into that trade, what your market assumption was, and most importantly, where you are going to get out. Know your exit strategy before entering the trade. And if you enter the trade, write that exit down, because you are more likely to stick to it if you have it written down. If you have it stuck up in your head, you're going to, when that time comes, you're going to try and squeeze it out a little bit more and a little bit more. And that is not being mechanical. And that's not how you get ahead in this game. Take the emotion out of it. It's not about dollars. It's not about making money and losing money. It's about beating the probabilities. And if you beat the probabilities and you stay mechanical, you guys, the money is going to come. You don't have to worry about that. Stop thinking about trading as making money. It's beating probabilities, you guys. Beating probabilities makes you money. All right? So with this strategy, we're going to be looking to take about 25 to 35% of max profit. Now, if you're newer to options, I would lean towards taking less, towards the 25%. If you're, you have a higher risk tolerance and you've been trading for a while and you're not worried about the fluctuations, then, maybe 35% of max value. So in that, if we were talking about that $5 wide scenario where the wings are $5 wide, we needed to collect $2.50 at least at the inception of that strategy, right? 50% the width of the wings. Now, 25% of that, how do we figure that out? Well, you can do a lot of math. But the easiest way to do it is say, hey, $2.50 is what I collected. I want to get out when it's decreased by 25%. Easiest way to do that is do the inverse times 0.75, and that will give you the value. So write down when you entered, if you got $2.50, I'm getting out at $1.87. You can round it down. And if you wanted to do it the other way where, hey, I've got a bigger risk tolerance, I want to go for more money, that doesn't seem like enough, times 0.75, what did I say? 0.75. Did I do 0.75 the first time? $2.50 times 0.65. So then we would want to get out when it's trading at $1.62. Okay, so write those down, right? When you enter the trade, put that down, because I can't emphasize it enough. I've seen too many people say, when this future gets to this point, I'm getting out, and it gets to that point, and what do? They write it out for another day and watch themselves lose money. And sticking to your game plan is the way to get ahead in this. If you trade with emotion, you're going to lose. All right. Max profit. Anytime you collect a credit on any strategy, this one follows the rule. Max profit is the premium received. So we are collecting a credit. That is our max profit. Our max loss is that in the money put minus the at the money put, or basically the wing to the base, right? What the width of the wing to the base is, minus the premium received. So we were talking about this would have been $5 wide. So, it would have been the 10, or say the 55 strike, the 50 strike, that's $5 wide, minus that $2.50 we received. Our max loss would be then $2.50, right? It's that difference. And then break even. You have two break evens because we have two wings. Now the market can go in one direction at any given time, but it can't go both directions at any given time. So it is an or, but you do need to know both break evens. And it's our out of the money put plus the premium received. So because we're collecting a credit, that short strike is the out of the money put. We add premium to that, and it brings our break even closer to where the current underlying is trading. Vice versa, on the other side, the in the money put, the higher put, that 55 put that we were talking about, minus the premium received of $2.50, our break even would be at $52.50 to the downside, okay? Or actually to the upside in that matter, sorry. Oops. So this is when I usually throw out the platform. So you guys throw me some stocks. We're communicating back and forth in the questions box. If you guys haven't noticed, throw out some stocks in the questions box. We'll go over it, see if it fits my rules. One thing to note, you do want this strategy to have volatility expand. And a lot of people say, is this a good strategy for earnings? I don't like it for earnings unless you put it on in advance of earnings for that expectation of expansion and volatility to help you. But get out before the earnings event, because that volatility crush is going to hurt you. You want the expansion, so I don't mind playing if you're playing that earnings, but make sure you get out before that earnings event. There's higher probability strategies around earnings that you can implement. Take advantage of that, all right? Another thing was dividends. Know that when you're looking at this, if you have an ex-dividend date in there, the stock should drop by the amount of the dividend. It doesn't always, but the value of the stock should drop by the amount of the dividend. So if this strategy is close to maybe one of your short wings, know that if the stock actually drops, that could hurt us. If, let's say, our entire strategy was out of the money, right? Now our puts would be, maybe our short puts were right here, and this was our butterfly, something like that. I'm just throwing it up there. I don't know if they're equal distance, but let's just say that it was right here trading around, 50, and they came out with like let's say it was a $3 dividend, right? Now that stock drops by that. We don't want that to hurt our strategy by dropping by $3 on that ex-dividend date. Does that make sense? If it's, the entire strategy is in the money on this put side, we don't care if it drops further, right? So you can play that. I would stay away from it because stocks don't always drop on that ex-dividend date. As a matter of fact, like Apple will maybe even jump by the amount of the dividend, sometimes, crazy enough. So that's not a hard, fast rule. It is a theory that should work out, but it doesn't always. Okay, so keep that in mind. You need to be conscious of dividends and earnings. All right, I see some people blowing it up out there with stuff. So I'll go with the first one I saw, which was, I think it's Colleen. She wants to look at Starbucks. So let's look at Starbucks. Let's delete that. Starbucks, I do have short puts on in there. 50% of my max value is right around 25 cents. I actually was trying to get out of that, but let's take a look at it. So Starbucks, what we want to look at is what's the implied volatility percent. It's right around 30. You know, it's 4% higher than 30. Listen, I'm not going to say anything about that. I don't care about that as much. That's our starting point. We want to kind of shoot for 30% because that usually gives us that best bang for our buck. It's trading around $57. So what did I say? Under $100, we need to have the bid ask at least 10 cents wide. We've got that. We've got that 29 days, closest to 35 days to expiration in there. So we're good there. The other thing we were looking at was the environment, the duration, the strikes we need to look at now. So at the money, 57.5 is probably the closest at the money. We want to buy 2 of those. And then I said, you know, what's 10% of that? It's about $5. So this one would be the one that's $5 away, 10%. So we want to move it in a little bit. 16 delta, that's pretty close. We're kind of in between both of those. So let's just try this. And then we did the 57.5, so that's the 60. Sell those. We have a $2.50 wide strategy, right? 60 to 57.5 is $2.50. We got $2.50 here. We're only collecting $1.07. So that's not 50% the width of the strikes. That would be $2. That'd be $1.25. So we're a little off on that. You know, if you wanted to put that in there and rack it up to 125, which is probably not going to get hit today, but it might get hit, you could do that. But I wouldn't go less than 50% of max profit. Maybe a couple pennies. You know, let's say this was trading, you know, 223. I might go for it, right? If I was really sure they're ready for a breakout. All right. So 50% the width. So I would skip that. I would go to a different strategy to try and do something for Starbucks on that. All right. Oops. Next one was Micron, I think. Micron Technology. I haven't traded this stock in a while. Let's just check and see when their earnings are. They don't have earnings coming up in the cycle that I'm looking at, so I'm good there. I don't have to worry about that. We're heading into that earnings, so you could get some volatility expansion heading into that event. It's probably not going to affect this option expiration nearly as much as it's going to affect this one, but it could draw it up a little bit. So we don't have an earnings to work around, so that's good. So it's trading $54.70. So we want these to be 10 cents wide. They are. That's good. We got implied volatility percent right in that wheelhouse. That's looking pretty darn good. It's trading 54.70. Closest to the at the money is the 55 strike. So we're going to buy 2 of those, right? And then start at $5 to the downside, which is a 50, and we're going to try and walk it in if we can, and then sell that one. What did I do wrong? That doesn't look right. So that's only getting us $1. That's terrible. 50, 55, 60. So again, this is one of those situations. We have a $5 wide. We're only collecting $1.30. I mean, that means I'm risking $3.60 some odd cents, 63 cents, right? Who wants to do that on a low probability strategy? I mean, I need to have a $5 move basically, right? So I'm going to stay away from it. Plus 25%, 30% of this is, you know, 45 cents maybe at best. So it's going to take a while to get that with this strategy. I would move on. Another one, somebody wants to go with the big dog, Amazon. Who did Amazon? Joseph, deep pockets. MU has high volatility. It's 23 IV percent, so it should be relatively decent. let's look at the chart. I mean, it has high volatility in and of itself. Like it has, like Apple's not going to have that kind of volatility. At least I don't think so. 40, yeah, Apple's got like 20. So, all volatility, implied volatility, you guys, for stocks is not equal. And that's a great point Gary brought up. Apple has a volatility of 19, and Micron had a volatility of 40, and that's pretty low for Micron, right? So that's why it's important to know the implied volatility percent, because the percent tells you where implied volatility is now for this particular underlying in relation to where it's been in the past. So it's also forward guidance. It's forward looking more so than historical volatility. All right. Sorry, I didn't mean to do that. And the way you figure out implied volatility percent, you take where the current volatility is, which is 48, subtract that by the low, which is, what is that? 36. So 48 minus 36, we've got 12. So in the numerator, we have 12. In the denominator, we take the sum of the high minus the low, which is, what is that, 89? I need my glasses. I can't see all the way over to my screen over there. 90. So 90 minus 38, was it? 36. So 90 minus 36 is 54. So 12 divided by 54 is somewhere close to, it's my math being rounded off, is lower than 23%. But you get the idea, is take the current in the numerator, take the current minus the low. That sum is divided by the sum of the high minus the low. All right. If you're using the 29 days to expiration versus next week at the 36 days to expiration, Larry, you can, if you wanted to get into that wheelhouse of the weeklies. I usually stay away from weeklies unless I'm trading earnings and stuff. The reason why they do have a tendency to be a little bit wider, like this is 15 cents wide in the weeklies, and we are like 2 cents wide in the monthly. So I would rather give up that extra couple of days in order to have a tighter market, because, I might have to give up 10 cents edge on a couple of different strikes in order to get into this strategy, right? If you have to give up that 10 cents here and there on a big strategy where we have 4 legs, that means if we have to give up that edge in the beginning, that means we have to wait for that theta decay to catch up to where we gave up edge, right? So I would rather give up the time and have a tighter market than have to give up too much edge. Okay. All right. Another one I saw was, I think it was IBM. Let's take a look at IBM. And I did this. I was looking at IBM for the call butterfly last week, but I wasn't around on Friday, so I couldn't implement it. And then it was Monday, and I figured I'd just save it for this one because I think IBM's due for a big breakout. It's been consolidating at the lows. Wall Street hates them. I think eventually Wall Street's going to love them again. They have gone from a service sector company to cloud computing. Service sector is low margin, high labor intense, whereas the cloud computing is low labor, high margin. I would much rather deal with low labor, high margin any day. So I think that's good for IBM. Wall Street likes them being a service company, and they've gotten beat up for it. If you looked into their earnings, they're killing it on the cloud services sector. But that still doesn't mean that my directional assumption in IBM is right. I've been wrong for a while now. You can see I've been like bullish on IBM for a while. ever since college when I was trading IBM. That was one of the stocks I traded in college. IBM and Walmart were my two favorite. But because they never go anywhere and you can always sell calls against your long stock and really rarely get it called away from you. So I'm ready for a breakout here. I have no earnings. I missed the dividend, so I'm all good there. So let's look at this. It's a $150 stock, let's call it. So 15 cents wide to the bid ask. We have that. We're achieving that easily. So this is a good stock to trade. What's my implied volatility percent? It's right in that wheelhouse, maybe a little bit low. But you know, we've got our target. We're shooting somewhere between 15 and 30, but you know, I can give up a little edge to the upside, 35%, maybe sometimes 40, depending, and you know, 11 to the downside. We would expect volatility to expand if it's this low, so that's good for me. It's trading at around 144.50, so the closest to the at the money is the 145. I'm not going to split hair, guys, on in the money and out of the money, but is that a double bottom at 140? Let's look at the chart. One bottom. I would, you know, a lot of people may not call that a double bottom. I would call that a double bottom. That's close enough for me for government work. It's inside the 139 handle and it stopped. You know, if it was 138 and 40, then, you know, we might be able to say, well, I don't know if that's a double bottom, but it's the 139 handle. I'm pretty good with that being a double bottom for sure. I probably should redo my Fibonacci's on that. But so let's say our theory is we've got a major breakout in one direction or the other, low implied volatility in my wheelhouse. So let's see if it fits the rules. We want to go, you know, maybe $15 wide to start. I'm going to start maybe a little bit less than that. I always usually go one tick inside of my 10% rule. Kind of brings you into line nicely. So I'm going to buy the 145s, and then I'm going to sell $10 wide, the 35s to the upside, the 55s. So this is what I was talking about. Another thing, we want our directional assumption to where this market rallies, right? Because we'd rather have these go out of the money because your risk of assignment is much less. If the market tanks, it will still be profitable, but you do start having that risk of being assigned. The other thing is it makes it more difficult to get out of the strategy if the entire strategy is in the money, because you can see once the strikes start getting in the money, the bid offers get a little bit wider than the further out of the money you go. So keep that in mind. That's also part of that bias that we kind of would rather have this rally if we were going to do that. So this, you know, fits my mantra. The other thing is this one works. So $10 wide, we've got $10 wide, $6.28. So we're getting $1.28 over my rule. That's gravy, guys. Anytime you're getting over it, that makes it like a neon green light. If this is the one I wanted for this one, you're over 50% by $1.25. That's beautiful. I would jump all over this, and I'm going to. This is a better setup than, you know, maybe it's the gods were watching over me and were like, don't do the call butterfly. Wait for the put butterfly. It's going to be better. Anyway. So analyze the trade. So let's look at the risk profile on. Oh, look, I still got my long call one from last week. That I just, or from a while ago. So short put butterfly, break evens, right? We subtract from the 155s. So 149-ish is my break even to the upside. So 149 right here. It's going to be my break even. And then to the downside, we add that premium. So 141 is my break even to the upside. So my break evens are pretty close to where we're underlyings are trading. So what do we say? 141 and 139. So, you know, 139, it's got to break new lows. And if it does, it's going to be off to the races. You break a double bottom, that's going to get ugly. And then what was my to the upside? It was $6 credit, and I was doing the 55 calls, right? I did the 55 calls, so that's 149 to the upside. So 149 is going to be like right around in here. So I'm good with that. Like there's a lot of room, no resistance to the upside for me, until it gets to basically this Fibonacci level. And then I'm already outside the wings, and I'm definitely going to be at my 25 to 35% of max profit if that happens. Does IBM short legs not get put to you? The IBM short leg could. This short leg could at any time be put to you. But the likelihood this far away is very small. Okay, so you aren't going to have to worry about this too much until you get inside like 7 days to expiration. That's when you have in the money options that you're short. You have to start worrying about it. Or if there's maybe a dividend, somebody for having stock on a dividend, nobody's going to put you the stock. But you do have to worry about the assignment when those are deep in the money. Somebody could do it, but it's probably not going to happen, 30 days or even probably 15 days out. And if they do stick you to it, remember you have an option covering that you can put to somebody else, so you can offset it, right? Another thing with getting out early with that 25 to 35% of max profit, right? We are going to probably have to take it into that last 7 days to worry about it, okay? Especially if we're right. Is your IV% study in your watch list self-created, or does that study already exist? That was I have the what is it, the code for it to do it. You basically build it out. There's a couple sections where it says custom. You just throw it in there, and you can ask us for that. We give that out to all our premium members. All right, so this is a really good one. Great setup. Over 50% of max profit. We saw it on the Analyze tab. Risking $400 to make $600. That is a win-win-win for this strategy. You aren't going to find much better than that usually. Another one we can look at is JP Morgan. So, if these guys are completely tied to interest rates. So having said that, if you think that the interest rates are going to go up and that's going to affect them positively, banks love high interest rates because they get fatter margins, and they don't like lower interest rates. So, it's an interest rate play that you're going to go after. You can do that. So 112, I'd say probably the closest to at the money is going to be the 100s, but we might have to check both of these. $100 stock, you'd go $10 down, but I'm going to go a little tighter just to check it out, see what happens. $5 wide, and we're only collecting $2 or $1.37. So that one would not work. So on this one, I'm going to probably have to try and go a little bit wider. Let's go with it. Did I do those right? 110, 115 to the upside. So let's try and go with let's check out the 115s and see what happens. 115. If you guys notice how I build these out, you can go up here and do the butterfly like this. I don't do that. I build them out myself. And if you're on toss, one thing to note when you're doing this, if you just click on it once, I can keep clicking on this. It's not going to add this up. But if I hold the control button down, you can see all these control key buttons come up. Control, add that, it builds it. So doing the 115s, let's look then at the 105, sell those. 115 to the upside, we'd be selling the 125s. So we have a $10 wide, and we're collecting a nice big chunky premium on that, over 50% by $1 or so. All right. So that is going to be one that would fit the rule as well, if that's how if you felt that JP Morgan was ready for a big breakout. All right, I think I got time for one more. And whoops, Visa, another interest play that you could kind of have the same scenario as you had for JP Morgan. It's $130 stock, 3 ticks to the left, 13 cents wide. We've got, yeah, it's close to, it's 13 cents wide, I'd say. You know, they're 13 cents wide. It's after the market. It's going to have a tendency to be a little bit wider. 21, we're in that wheelhouse. That fits that rule. All right. So we're in all of that. Let's just check for earnings. Earnings outside. We've had dividend. Make sure the dividend already happened. Dividend's happening. So it might happen Central Time. So dividend caused it to drop. We're good now. All right. So Visa, it's 130 is the closest to the at the money. We're going to buy 2 of those. Usually it'd go about $10 down. I'm going to lean towards going $10 to $15 down. So I'm going to go $10 down. So I did the 130s. Let's do the 120s and then look at the 140s and go that way. So the 110, let's just make sure I did this right. So 20, 30, 40. So that's $10 wide. You know, that's why I was saying, you know, you go shoot right around all of those different things. It's 60. It's not going to ever be the necessarily 16 delta, the 10% width of the strikes, but that gives you an idea of where you can start to build this out. So you're not like just plugging and playing and trying to, you know, pin the tail on the donkey. Okay. So that one would work out as well. And I think I see a couple of questions coming up and I might need to grab my glasses. All right. Answer the IB one. Does IBM short leg not get put to you? I answered that one. For the short put butterfly, if you did the same strikes for the short call butterfly, are the credits similar and the P&L curve the same? The P&L will well, it has to do with skew on options. So if the puts are getting pumped up, then, you know, the puts are going to be the better one. If the calls are pumped up, then the calls are going to be the better one. So let's just take a look at it though. For that, we did the 20, 30, 40. So let's do the 20, 30, 40 call one just to do a comparison real quick. 20, 40, and 20. So it's close, but there's obviously skew to the put side here by about 30 cents. So you can do that as well. Go check both of them because the directional assumption is on both of these, either direction. You know, with the call, obviously, we would like it to go down. So these in the money calls go out of the money or at least to at the money, right? But, you know, that's going to be on the bias. If it were me, I would go probably for the extra 30 cents and worry about my directional assumption later. Okay. I'm going to go for the thicker premium because, you know, 25% of 40 cents is another extra 10 cents, right? On my collection, if I'm going 25%, 35% of max profit, right? If I've got 40 extra cents, I'm getting an extra dime on my thing, on my rule. Good for CL options, crude oil? Absolutely, Fernando. It will work across the board in all futures. I usually talk a lot about futures with trading these strategies because a lot of people trade stocks, but yes, you absolutely can. You can do it on ETFs as well. ETFs, this will work. I would lean towards slightly lower than, you know, I would probably shoot for somewhere around 10 to 20 IV percent because it's a basket of goods and they all kind of average each other down in a sense. Yeah. Definitely, it'll work on any of that stuff. All right, guys, that's it for today. I want to just do one last thing, give you guys this offer right here. This is on trading options. It's more geared towards the beginner, but I will tell you that even if you are a trader of 20 some years, you are going to get your $36 in value out of this. I guarantee it. Well, I can't guarantee anything. No, that's one thing I'm not allowed to say is I guarantee anything. I don't know why. But you will more than likely get your $36 out of this options course, even if you've been trading forever. Because I've had conversation with guys that have been trading for 30 some odd years and they don't know the history of options. That's one thing. It's a great little chat for around the campfire or at parties. But all of these other ones are really important, especially protecting your portfolio against rising interest rates. I can't emphasize enough how important that one is, because it is the most neglected portion of anyone's portfolio. So make sure you guys take advantage of that. Oh, sorry, you guys, this link right here is in the chat window. We've been going back and forth in the questions box. If you look over there at the main bar, you'll see something over there. It's the chat window, and that's where I've posted the link there for you guys. If you don't see it, please let me know, and I'll try and fix that. But at the end of the day, you guys have seen this strategy before, I'm sure, online, heard other people talking about it. They don't really tell you guys what you want volatility to do. They don't tell you how to figure out your strike location, streamlining your process. That's what I am a huge Six Sigma type of guy. And it goes down to me loading the dishwasher, trying to streamline that process. I'm like anal retentive about that stuff. But having said that, I don't want to mess around like trying to pick different strikes and doing these. It's not working, and I need to pick another strike. And how do I get to the end game as fast as I can? And it comes down to even the trader hacks that I give you guys on how to figure out some of these things. It helps you make the decision quickly. Time is money. And if I'm sitting there banging around trying to pick different strikes for 15 minutes to try and get the strategy to work, I am basically done with that strategy, right? It's too much complication. Yes, I do add complication to this strategy in that you have to fit the rules in order to implement this strategy. Okay, I'm not going to lie. But knowing that your probabilities of success have increased dramatically, it's worth that. But setting up this thing and figuring it out, I don't want to be banging numbers around all day. I want to get to the meat and get it done. So basically what I'm saying is the best way to become a better trader is to constantly learn, which you guys have obviously done. And ultimately knowing how to build a strategy isn't enough. Even just knowing technical analysis isn't enough. We're playing with probabilities here. And yes, I do look at technical analysis, support, and resistance, but it's not the end all be all, you guys. A lot of times when I am perplexed, don't know what market assumption I want to come up with, I'm going to pick something that doesn't have a market assumption, which this fits the bill in that case. I don't have a market assumption other than I believe this thing is ready to break out. So wouldn't you guys say that just knowing how to create an option strategy isn't enough, or just trading that technical analysis? Ultimately, knowing how to properly set up a strategy increases your probabilities of success, and therefore you will be more successful. And that's how I teach, how to trade the probabilities. When the probabilities have gone against us, how we can stay mechanical and increase our probabilities by being mechanical and further increasing those probabilities in our favor anyway. But basically when you're trying to, when you're trading with the right tools, you guys are going to have a more productive state of mind. You guys are going to be able to put on more strategies, which creates more opportunities, and ultimately you are going to be more confident in these strategies. Now, listen, this strategy may not work out for you the first time. The probabilities may beat you, but keep in mind, when any one of these strategies that I teach, the probabilities have beaten you, just know that the next one coming around, the probabilities are going to be in your favor, okay? Probabilities are the probabilities, all right? So when you're using the right tools and right situation, you guys are going to be more productive state of mind, and you guys will be better traders for that. So we're offering this for you guys today. I suggest you take advantage of it by clicking on that link that I have there in the chat window. And if you guys learned anything at all from me today, you guys should seriously take advantage of this, because I'm sure you're going to learn something and be able to have some takeaways from it. So what do you say? Go ahead and click on that link there, and I'll get you guys set up right away. Last thing I want to do is just thank you guys. It's also got the link here, but I want to thank you guys all for attending here. Later webinars, I'm going to be drilling down on different option components and how trades I find, when and where I find them appropriate. You can stop or pause this write this down or type it into your URL to get that. If you're watching this on tape delay, just guys, want to thank you guys all for watching. You can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, so this is that link again. That's all I got for you guys. I got a couple questions coming up. I'll try and answer those after this in a second. But if you can't take that, take it easy. JQ, I didn't think you were here. Thanks, buddy. All right, let me try and get a couple of these questions real quick before we get off. The weekly webinars, Wally, it's almost a year long. When will I get the recording? Banu, I'm going to be trying to upload this right afterwards. We try and send them out, so it should be getting to you hopefully in the next couple of hours. What is that probability of this strategy? It's 50-50, Nancy. 50-50 probability of success on that one, because basically you're collecting 50% there. Is this course for download only or emailed to us? We will email you this video, Art, but if you guys want to do the courses, like all of these courses, basically if you bought this course, instead of having dots here, there's little boxes. And once you've watched it, you can check them off. So you don't have to necessarily watch them in order. This is over 10 hours for $36. And then you don't end up watching them over again on accident, right? Another great webinar. I appreciate your help, effort, and knowledge. Thank you, Ted. I appreciate it. JQ, appreciate you. All right. Thank you, Wally. I appreciate all your guys' kind words. I'm not going to bore everybody with all of the compliments and stuff like that. Nancy, I will tell you that we both teach very similar to, when we were in the pits together, we all learn together. So if you're talking to a pit trader, you might be able to get some of the same information, because we pretty much know the floor trader hacks. Like everybody knew if you were on the floor, you knew that if the deltas, the probabilities, and all of that stuff. So, all right, great. That's about it. You guys have a great night and good trading tomorrow. Watch the daily market commentaries, because I'm going to be putting on one of these trades tomorrow during that webinar, and we'll be talking about it a little bit more. And I also talk about all the trades I put on, when and where I take them off, all that stuff, all right? Where do we find that? The daily market commentaries. Nancy, reach out to us. I don't know exactly where on the website you find it, but basically reach out to us at 310-598-6677. Tell me you want to start getting those, okay? Great.